It is 7 a.m. Eastern. You open your terminal to see the London session has already moved 80 pips. You feel the FOMO creeping in. Most retail traders assume the move for the day is already over, or worse, they assume the current trend will simply continue forever. They buy the top of the London move, only to watch as a violent reversal wipes out their position. Professional traders recognize this window as the New York Killzone. Between 7 and 10 a.m., institutional algorithms take over the market to hunt for specific pools of retail liquidity. To survive the morning Forex market, you have to stop chasing the trend and start executing a strict time-based strategy. The first phase runs from 7 to 8:30 a.m. This is a pre-market waiting period where price often meanders aimlessly sideways. During this time, the algorithm is building up liquidity. On this chart, we can see retail stop-loss orders clustering just above the London high and just below the London low. Think of this as winding a spring. The algorithm is setting the stage to sweep these specific predetermined boundaries. Executing trades here is low probability because the algorithm has not yet revealed its true directional intent for the New York session. At exactly 8:30 a.m. Eastern, the U.S. economic calendar typically drops high-impact news like CPI or retail sales. The news is the excuse the algorithm uses to reach for liquidity efficiently. The resulting spike isn't random chaos, it's a targeted strike. This is the Judas swing. Price spikes above the London high, triggering retail buy stops, then forms a heavy reversal candle. We confirm the move looking for a market structure shift. Here, price breaks below our recent swing low, proving institutional expansion has begun. The professional strategy is to wait. You don't trade the initial news spike. You wait for the Judas swing to trap the sucker money before entering the reversal. At 9:30 a.m., the opening bell of the New York Stock Exchange brings a massive influx of equity volume into the system. This liquidity injection creates the most volatile and predictable moves in pairs like gold and the major USD crosses. We are looking for displacement, a sharp, energetic move that clearly breaks through levels and leaves behind fair value gaps. Identifying displacement at 9:30 confirms that the 8:30 news trap was successful and that the real trend is now locked in for the morning. To trade like an institution, you use the US dollar index as a primary filter. It provides the necessary confluence to verify if a move is genuine. By comparing the DXY to your target pair, you can spot SMT divergence, the hidden footprint of smart money accumulation. If the DXY makes a new high, but your pair fails to make a new low, it signals institutional buying. This chart shows the divergence clearly, marking where smart money is entering against the retail trend. Using this tool allows you to ignore retail indicators and align your trades with actual institutional intent. From 10 a.m. to 11 a.m., the market enters the silver bullet hour. This is where the initial morning volatility settles into a sustained move. Once the algorithm has swept the London high or low at 8:30, the opposing session extreme becomes the logical draw on liquidity. By 10 a.m., the market is often moving directly toward that secondary target. Traders can take high-probability secondary entries by looking for new fair value gaps that form during this hour as price expands toward the target. Discipline is key. At 11 a.m., the institutional window closes. The professional closes their terminal, while retail traders stay behind to lose their morning gains in the choppy lunch hour. Mastering the New York Killzone aligns your trading with the specific time windows used by institutional algorithms. To prepare for the next session, download the FXNX economic calendar to track the 8:30 a.m. high-impact news events. You can practice identifying these setups by opening an FXNX demo account today, featuring institutional-grade technology and 0.0 pip spreads.